Okay, welcome to the last podcast for chapter 14. In this one, we're focusing on operating leverage. So remember that operating leverage deals with our cost structure, so fixed costs and variable costs. So as volume moves away from break-even, profit or loss potentially increases faster with more operating leverage. This is the risk effect. So the more operating leverage we have, the larger variations in EBIT. We'll see an example of that. So low operating leverage, high operating leverage. So our break even, as we move away, it's not very magnified, or as we get closer, you can see with the high operating leverage. By the way, what makes a firm high or low operating leverage tends to be this item right here, fixed costs. Notice that the lower operating leverage has much lower fixed costs. The higher operating leverage has much higher fixed costs. So as a general rule, firms that are highly automated tend to have high operating leverage. Think of a ski resort as a good example. If they have a lot of snow and people are going there, they can have a very profitable year. If they have no snow and people aren't going there, they can lose a lot of money because most of their costs are tied up, are already spent, their fixed costs. Let's look at this goofy little problem. We just want to show that these two firms have the same break even. So let's assume the low-level firm has $1,000, a fixed cost of $1,000, and it sells its products for 10, and its variable cost is 8. So its contribution margin is 2. The high-levered firm is fixed costs are $1,500. It also sells its products at 8. Both firms have the same break-even point. All right, so both firms have the same break-even point of 500 units. And for the low-level firm, we know that's 1,000 divided by a contribution margin of 2. So let's solve for variable costs for the high-levered. So we know that break-even is 500 units divided by, 500 units equals fixed costs divided by contribution margin per unit. Well, we don't know the variable cost, so it's 10 minus variable costs. So variable cost equals 7. All right, so $1 difference in contribution margin, 8 versus 7, makes up the difference in the fixed costs. Which is better? This asks, which is a better structure? Well, it depends. If you're in a highly volatile business, having a lower fixed cost structure might be better. If you're in a more consistent or growing business, then having a higher fixed cost structure might be better. One of the things you're going to have to calculate is the degree of operating leverage. The operating leverage amplifies the changes in sales into changes in EBIT, or again, the degree, so the degree change. So degree of operating leverage relates to changes in volume as it relates to changes in EBIT. You can see that formula there. And we have an example. I didn't let's turn this thing off so you can see what I'm doing here, so I'm not cutting it. Okay, now you can see the whole screen. My big head isn't blocking a corner of it. Okay, so this company sells products, average price of $10, variable cost 7, fixed costs are $600 a month. Evaluate the degree of operating leverage when sales are 5%, then 50% above break even. So let's do the 5%. So first of all, let's calculate what break even is. And break even we determine is 200 units, right, if we do that formula. So break even plus 5% is going to be 210 units. So 210 units gives us degree of operating leverage of 21. At 50, where did I do this other one? 50%, it's 300 units. That gives us a degree of operating leverage of 3. All right. I think I got a better example than that. How about this one? That was from your book. I think I put this one in because I think it makes a little bit more sense. Okay, so in this case, we have contribution margin of 100,000. We have EBIT of 20,000. So our degree of operating leverage is 5. What this means is if we have a 10% increase in our sales, that is going to increase our EBIT by 50%. That's what the degree of operating leverage means. It's how much our change in sales will impact our EBIT. And so here's the verification. So we originally were selling 500 bikes, now we're selling 550. So there's the 10% increase. And we have an increase in sales and variable and contribution margin. So a 10% sales increase from 250 to 275 changes operating income from 20 or EBIT from 20,000 to 30,000, which is a 50% increase. All right, so that's the idea behind the degree of operating leverage. All right, comparing operating and financial leverage. Financial leverage involves substituting debt for equity. So it's changing our capital structure, and we have more control over that than our operating leverage, because we basically can choose how much debt or equity that we want to have. Operating leverage we have less control over. We may not have that much control over our variable costs. The market may impact our sales price more than we have control over it. So operating leverage involves substituting fixed costs for variable costs in the firm's cost structure. The more fixed costs replaces variable, the more operating leverage we have. So both can enhance results. Both involve substituting fixed cash outflows for variable cash outflows. Both make risk larger. And remember, capital structure affects financial leverage, cost structure affects operating leverage. The risk and relationship. So operating leverage, it amplifies or increases business risk, and it substitutes fixed costs for variable costs. Financial leverage creates, if we didn't have any debt, or amplifies financial risk if we had debt, and it substitutes debt for equity. The effects on financial and operating leverage can compound one another, and in fact we can put these things together. So the degree of total leverage is the degree of operating leverage multiplied by the degree of financial leverage. And make a note of that because you'll have to do that in the homework. Okay, and that concludes our podcast for Chapter 14.